Blast off here. All right, we are live. So I'm going to call the committee to order. This is the Senate Finance Committee. This is January 28th. And the first item on the agenda today is a report from the Tax Structure Commission. I understand that this is not final, but since it was getting reported in Digger and various other places, and we were starting to get emails, I thought we should get a look at the draft and at least know what you're talking about so that we can start looking at it. So I've got Deb on first, but this is your show, so I don't know what you've got planned. The floor is yours.
Thank you. I think what we gave you was sort of an order of the major taxes. And I thought maybe I'd just start with a really quick overview of the way we looked at the whole process. So you can figure out who can answer your questions.
Do we have any documents from you?
We have the draft report, and I can call that up at whatever point if there's relevant.
Okay, but you all right, so, but you don't have a PowerPoint or anything. So
No.
If you send the draft report to Faith, she can get it posted and we can all read it.
Senator Cummings, it's already online.
It is online. Okay, so you can check that out online, folks. All right, there we go.
And it's very long. But so anyway, we were set up by Act 11 of the special session in 2018. And I understand that the language came from your committee to set us up. And so 3 people were appointed, one by the governor, one by the Senate President Pro Tem, and one by the Speaker of the House. And Bram organized us with this sort of geometrical idea of how we were going to put all the pieces together. And it kind of goes like this, that there are 3 main types of taxes: the income taxes, consumption taxes, and property and education taxes. And there were 3 of us with different expertise. So we decided that one of us would take each of those main taxes and we would take the responsibility for sort of organizing the analysis needed, the discussion, the recommendations, and even draft the final report. And so I was thinking maybe at this point, well, I'll tell you, Steve took income tax, Bram took consumption, and I took property and education. And so I was thinking maybe if they each introduce themselves, you could understand why they got those chapters. But I'm not sure that I see Steve yet. But Bram, would you like to just introduce yourself?
Sure. My name's Bram Kleppner, and I am CEO of Danforth Pewter in Middlebury. And before that, worked at Ben & Jerry's for a bunch of years. I have also worked on public policy as a member of the Governor's Business Advisory on Healthcare Financing, and I co-chaired the Medicaid Exchange Advisory Board for 5 years. And I think I got consumption taxes a little bit by default because, Deb's an expert on education financing, and our 3rd commission member, Steve Trenholm, is a CPA who works at Gallagher Flynn and knows the income tax law inside and out. So, I run retail stores and we charge and remit sales tax. So that's why I worked on that.
Okay. And
I should add that Steve, you'll hear more from Steve and he can introduce himself when he gets here. But as Bram said, he's a CPA and he has an MST, which is a Master's in Science and Taxation, something that I didn't even know existed. But he provides tax services to individual clients as well as to corporate and business clients in taxation, especially income tax. So anyway, we took those three taxes, we assigned types of taxes, we assigned one to each person who had the greatest experience in that area, and we called those the verticals. And those are really the easiest to sort of look at each tax individually. And then we also had these things that we called the horizontals. And the horizontals are the things that sort of cut across each of the main tax types. And there's sort of two types of the horizontals. One, we looked at future trends, things that are changing society or changing our economy and will affect the tax structure. And those were demographics, change in demographics, changes in technology, and climate change. And essentially, we just looked at those to see how the tax structure could weigh in, would have to adapt, and mainly came to the conclusion that it had to be agile. The second type of horizontal is really the analysis and evaluation of the structure as a whole. We're not the tax commission, we're the tax structure commission. And this was actually the most difficult part because we had to somehow put all the taxes together and figure out how they were working as a unit. As recommended in the Act, we used the National Conference of State Legislatures principles to evaluate the structure. And we also looked at the role of assets in two ways. One is that the Act asked us to look at an asset tax. So we did look at the asset tax, but we also realized that assets were a very important part of the ability to pay. And we recognize that. So it should be important in figuring out our tax structure to make sure that it does accurately reflect the ability to pay. But we found that that was just a real bear to figure out what assets people have, how to measure them, and how we could possibly tax them. But we did work on it. And so we started out, the first thing that we tackled was the education tax. And I guess I forgot to introduce myself. But for those of you that don't know me, I've been working with the legislature and the administration on tax issues, particularly education finance, since prior to Act 16. And so the last Blue Ribbon Tax Structure Commission, which was finished up maybe 7 years ago or so, had focused on the income tax and hadn't really had a chance to dive into the education tax. And they recognized that and recommended that that be the next step. Also, Senator Brock came to talk to us and mentioned that that was your understanding or your reason for asking for this. So that's where we started. And when we started, we were able to hold public meetings. And so we had a lot of public meetings, and we asked for comments, and we certainly got comments on the education tax. And actually we got so many comments that it took quite a while to organize them, to compile them, and think through them all. But after we grouped them, we came to the conclusion that most of the problems stemmed from the complexity of the current system, not so much the principles, or the net result, really just complexity. And when we went through the comments, rather than look for a single change to each point raised, because there were so many comments, we realized that if we looked for a little fix for each of those points, we'd end up making a lot of little fixes, a lot of tweaks that could even make the system more complicated, more complex. So instead, we decided to look at overall structural changes that could address as many of the issues as possible. And so we started with 5 alternative approaches. And we were looking for, we decided that the best tax, for the best structure for us to recommend would be one that was direct. The current homestead tax, as you know, is not direct in that people pay a property tax 1 year and then get a credit in the next year. That's related to what they should have paid had they paid on income in the first year. And that disconnect was really confusing to people. So we wanted a direct tax. Then we realized that a second problem causing confusion is that we essentially had a double tax. We had an income tax and we had a property tax. And that meant that we had to administer both of them. The income tax and the property tax, they're done by different levels of government. They have different schedules. They have different confidentiality rules. So not only did we have to do those two separate taxes, but then we had to figure out how to make those work together. And that was like a third layer, really, because of the different schedules and the different actors, really. So we decided it would be important to choose one tax and not have this double structure. And we looked at a pure property tax. One of the alternatives was pure property tax with a big homestead exemption. But ultimately we realized that we would need to layer over an income tax on top of that to correct for the regressivity. So we decided if the one tax would be the income tax, that it's more in sync with the ability to pay. So our recommendation is dealing with, or maybe I should say that we decided to keep the non-homestead property tax as we have it, the yield mechanism for setting rates, so that equal spending gives you the same rate in every school district. Equal spending per pupil yields the same rate in every school district. We thought that was working well and wanted to keep it. We also explored the possibility of just having one state education tax rate that could be, say, a progressive income tax. And then it would be distributed back to the districts based on pupils and a formula that would weight them some way or other. And decided that the local control aspect that we have now, where districts vote in the amount that they want to spend, is important for local democracy. And so we decided that local control aspect would be part of our recommendation also. So the one we ended up with is like really simple, in concept at least. And it is essentially an income tax based on a yield for all residents. And I'll just walk you through like a little example what would happen this coming year. So let's say we're in March and we've gotten around to filing or starting to file our income tax based on the year 2020. So we have a good idea of what our adjusted gross income is. And we go to school meeting and the budget is presented and it's broken down into a spending per pupil. We take that spending per pupil, well, the school board would do that. They take the spending per pupil, they divide by the income yield that maybe is sitting in House Education Committee or wherever, anyway, from the December letter, whatever, they would take that estimate and they would say, they take their spending, divide by that spending, by that income yield, and that would give you the tax rate. And let's say it's 2.5% of your income. So you would know that your tax bill would be approximately 2.5% of your AGI that you're in the process of filing. We're hoping that um, people would pay this amount through, not in a lump sum, but rather through estimated taxes or through withholding during the year, with a wide band of what they would have to come up with during the year. And then the final reconciliation would come in next April when they file their income tax. If they had overpaid, they would get a credit. If they had underpaid, they'd have to pay the remaining amount. The newer twist in here that we haven't been able to estimate is that we couldn't think of any reason, any principle-based reason that renters were treated differently in terms of school taxes than homeowners. And particularly when we got into the discussion of local democracy and ownership of your school district and that responsibility, that connection between what you vote and your taxes, we felt like there was just no reason that renters shouldn't be treated the same way. So we're proposing including renters in this, yet paying a renter credit to recognize the fact that they're paying property taxes through their rent. And we think that we want the rental credit to be refundable so that basically people could get the renter credit if they don't owe any other taxes, or if it exceeds the amount that they pay based on this. Yeah.
Do you know that we passed a renter rebate reform bill last year? It's waiting to go into effect. They've got another year because of COVID. How would those mesh, or do we need to undo our vote?
I think they should mesh perfectly. And it's one of the reasons that at first we envisioned the credit as actually offsetting the rent paid on the unit. But given that the renter rebate change that you passed is basing it on the median rent in the county, it would make sense for us to do the same thing so that there wouldn't have to be a separate calculation, a different determination of that.
This would be paid as a surcharge on your income tax, as a separate tax, a school tax based on income, separate form and filing?
I would envision it being clearly separate, maybe filed at the same time, but clearly separate form. That's your school tax. So that's the basics of our proposed change. And we know that we'd have to do some more research on rents and renters to figure this out. But essentially, if we could assume that the renter credit and the amount that renters will pay in aggregate is the same, and the non-residential property tax doesn't change, so the amount that it brings in aggregate is the same, then the amount that we're raising on just the homestead tax would be the same. The shift would mainly be higher income people would pay more than they are now. There's a chart that shows what people are paying now as a percent of their income. And it looks fairly flat, but it does go down at the high end. So incomes higher than, I don't know, I guess I would say $300,000, $400,000, somewhere around there, are starting to pay less as a percent of their income than people making $80,000. So there would be a slight shift there. And when this has been brought up before, Senator Pearson, for example, had a, oh, thank you, Sean. So this is the chart that shows across the bottom, you have income categories, starting from the lowest, going up to the highest. And the gray bars are showing you what the property tax would be if people were paying on property. And then the blue part is showing you what they ended up with under current law. And so that basically that's the effect of the income sensitivities we have it now. And you can see that at around 140,000, people are paying 3% of their income, and then it goes down as you go higher up. So essentially what this would do would be pick up more from the higher end. And when we looked at something like this before, when Senator Pearson asked about it, people had made the comment that we need to have a maximum income. In other words, you pay the income percentage times your income up to an income of whatever, say $1 million, just as you do with Social Security. At that point, you don't go higher up the income. Even doing that, there's a little bit extra money that you could use to lower the rate, or you could direct to lower income. We also didn't envision scrapping the rebate program, but we did want it to be something rather than a circuit breaker program with clunky steps in it. We thought it should be something where, to use an expression that's often misused, but people have skin in the game. So in other words, instead of saying, if your education tax exceeds this amount of your income, you don't pay anymore, we basically say, as your income goes below a certain point, the percentage of the tax that you pay is less. So you'd go from 100% of the tax to down to 75% to 50%, lower like that. So in other words, if you vote something in, even though you're only paying 75% of it, it still goes up.
Have we calculated any numbers on what the difference would be for somebody at the top of the bracket, the 500,000 to $1 million? What would their tax be?
The same as everybody
compared
else's.
to today's
Well,
tax? Do we
okay.
have any? I mean, I'm sensitive to things that go up like that tend to cause a revolt.
Right. In terms of percentage of their income, they'd pay the same amount. In terms of dollars, it would be more. In terms of being able to answer your question, unfortunately, I have the runs that I did for Senator Pearson a lot of years ago, but we weren't able to do much modeling because there was just no capacity at Joint Fiscal Office because of COVID. So these are things that we're itching to figure out.
So we don't know how much more any individual be. And I know when you get to the very top, either we have less than 10 or none because the tax department couldn't give me that breakdown. But this still would not pick up assets. So that if I'm working for salary, and I assume it's household income, so both my partner and I have good jobs and are getting paid well, we would pay on our full wages. But if I had $20 million in a trust fund and chose to only live on 80 or 90,000 a year, I would pay on the 80 or 90,000 I drew down from the trust fund, but not on that asset value.
So
Okay.
that's exactly the question that we spent a lot of time trying to figure out. And all we did was lay out some of the issues with that and, recommend that we have to go farther to figure this out, but we couldn't estimate that. So you're right, we are not including assets in this, but actually we were going to AGI as opposed to household income. And that's one of the advantages when you have renters in the game. You no longer have to put people together and tax them based on their household unit. Everybody just pays on their AGI. So it simplifies that, both the calculation, the administration, but also the I don't know, sort of perverse incentives that figuring out how to play the household income game created.
And
Deb,
I
if
would,
can,
What
Yeah,
about the people, the 50% that are only in that top bracket 1 year? There's a lot of movement in that top bracket.
So they
And,
only pay in 1 year.
but I've just sold off the family camp. That's the money that I'm going to use for my retirement. My normal income is 75,000. We're not gonna, I've gotten more than one person who sold something to pay the property taxes, only to find out because their income went up, their property taxes skyrocketed. And and they didn't end up any farther ahead. So this would be just on a year to year, everybody cash income only. AGI, but
And
no
if I-
assets, no.
no, sorry.
Nope.
Okay. So it is true that the very high wage earner is going to go from paying an education tax based on their property value to their income, and the dollar amount is likely to be higher. Absolutely. There is the offset, though, that the education portion of their property tax on their primary residence goes to zero, and the correlation between property value and income isn't perfect. The data is a little bit messy, but in general, higher income people are in higher value properties and are paying higher property taxes. So there's a little bit of an offset. Your education income tax goes up, but your education property tax goes to zero.
Right, but I was thinking if I'm paying $8,000 in property tax and next year I get hit with $20,000 in an income tax, that's sticker shock. And if I don't have any kids in the school, I retired here, I might have an issue with that. So Senator Pearson.
Yeah, I think it's worth remembering that the sticker shock from your $20,000 school income tax bill correlates to your $1 million of income. So even if it is selling the camp, that's a pretty nice camp. I don't know too many people that sell $1 million.
No, I'm thinking of the $300,000 camp
So they don't get a
that happens to
20,000.
be on a lake and it's been there for 75 years.
Yeah,
My
and they're
family
paying
happens
it.
to own $1 million camp on the ocean. My father built it. It didn't have hot water or heat, but the neighborhood has improved and paying the taxes on it is challenging.
Well, it's not that challenging when you sell it for $1 million. I mean,
No, but
But-
you're forcing it to be sold, and it has been sold.
And
well, it's interesting because we're actually easing the burden on you while you own it, and you do
Well,
get a
if it's
hit
a
when you sell it. I mean,
If it's
that's
primary.
so.
yeah.
I'm curious. First of all, I just some context. Obviously, as Deb mentioned, I've poked at this for a long time. I was trying to find the headline when Bud Otterman and Joey Donovan and I put this, it was a great Free Press headline. Lawmakers put income tax for schools on the table. And that must have been 2007. So we've been nibbling at this for a long time. At least 2/3 of Vermonters, if not closer to 80% of Vermonters, are paying based on income today. So it's not a wild change for most people's experience. I just think it's important to ground it there. And Deb, I'm curious that we've always, every time we bring this up, people tell us the transition is really hard. The first year is brutal. You seem to have addressed that by having some kind of withholding throughout the year. So we don't have to borrow to fund 1.5 billion of ed funding, or the income tax piece of that, $600 million of ed funding for 1 year and then pay it off. You're saying we can stage that through a withholding mechanism or something. Do I have that right?
For individuals, I just think it's easier not to pay in a lump sum.
Yeah.
That's always been a complaint with the school tax. In terms of transition, I don't think it's that difficult because the net that we're getting in any 1 year is very close to what we're going to get. In other words, we haven't shifted between non-residential and residential or something like that would make a big change. So I don't see the transition as being difficult.
Okay. So then I just want to talk about renters, because I think you said that you imagine the credit that we're giving renters to roughly be equivalent to what we're charging them. And so that begs the question, well, why charge them? Why not say, homeowners, you're going to start paying for school this way? Most of you have been. But leave renters out of it. Yeah.
Yeah, I think that was a little confusing. You're
Can you
right.
just introduce yourself for the record? Because we didn't get to
Oh,
hear
yeah,
from
sure.
you before.
Yeah, I'm Steve Trenholm. I'm vice chair of the commission, CPA by profession.
Welcome.
So Senator Pearson, I understand your confusion there, but what the credit that we were talking about in the report is based on if that property, because it's not homestead property, it's still going to be subject to the non-homestead property tax. The renters would get a credit based on a formula of what they paid in their rent towards that non-homestead property tax, not completely eliminated. So they'd pay something.
Yeah, no, that was clear, but I thought Deb said basically what we're crediting to renters and what renters pay in their income tax will balance out. Did I mishear that, Deb?
Yeah, so the easiest thing would be to just not tax it in the first place. So you don't tax the landlord. But we're afraid that's not going to get back to the renter. In other words, we're afraid that the rent will stay as high as it is. So that's why we feel like we keep the tax on the rental units and we refund it to the renters.
So why not only charge a school income tax to homeowners and leave renters as they are now, which is, and this is, I'm asking because this is interesting. This is a real deviation from the
Right.
discussions we've had in the past, and maybe it makes sense, but I'd like to understand.
So that was our option 2. And so in the appendix, we have the other options that we considered. And the main reason we decided to include renters was democracy. Really, we wanted them to be part of the school tax decision-making in the same way that the homeowners are. The other advantage it has is that you can go just straight to AGI and not have to make people decide who's in what household unit and, track that. Basically, everybody just pays an AGI based on their residence. And their town or their district, their school district residents, not their particular roof over their head.
And if I might just add to that, I think the goal is to ensure that renters don't pay education tax twice, once through their rent on the non-homestead property tax and once through their income on the education tax. So for democracy and for fairness, all the residents are contributing equally through the income-based education tax, and the non-residential properties are contributing at one equal rate through the non-homestead property tax, and no one should pay twice.
I'd be interested to see how we could mesh that with the renter rebate reform we just did, rather than have something just passed and then having to be removed or not withstood. Senator Brock, I know you were the mover and driver behind this study, so.
Thank you, Madam Chair. I've got a whole bunch of questions, but
I'm not surprised.
I'll leave it for 3 for right now. The first is when we pick up news magazines, the Newsweeks and Business Weeks of the world, we always see the ratings that rate income tax by state in terms of would you move to the state? And these are the highest and lowest marginal income tax rates. What will this proposal do to that kind of analysis, and where will our top marginal rate be?
Depends on your school district.
Yeah, well, basically it would be 2.5% of your income. That would be in addition to, whatever your rate is. But, the more we thought about this is where we get into the tax structure. The more we realize that you can't, so people compare state to state, they'll compare top marginal rate, but the amount that you actually pay depends on where the brackets come in to get to that rate, and whether or not you recoup the lower bracket rate, or all sorts of reasons that make that top marginal rate not the best thing to measure. And similarly, you have some states that don't have an income tax or don't have a sales tax or something like that, but higher in other ones. And it just seems that you can do that. You can compare a certain factor and say, this is going to be high in the state. But the only reasonable way to decide if the reason for moving to a state depends on the taxes, it would just seem that you have to look at the entire picture rather than just one particular combination. So you would have an additional income tax, and I don't know that you could correctly add it to the rate because it's sort of a different base, but whatever, you would also have a much lower property tax.
And I think
Senator Brock,
Some
I'm
people
sorry.
would.
Go ahead.
what we envisioned basically for this was, yes, it's based on income, but it wouldn't technically be classified as an income tax. So your rates would stay the same. I know, Senator McDonald, you're laughing, but
I'm laughing because the chart that you're looking at is one of 24 charts.
right.
Some people who write the chart will count it one way and some will count it the other way.
Right.
Same dilemma we have with people saying that our state taxes are extremely high because we have a statewide property tax, where in all other states, almost all other states, education is paid for with a county tax. So it doesn't show up. Yet
Right.
people with a straight face will argue to us that our state taxes are high, and they'll just ignore that.
Okay. I'm not going to get in right now to reasons why people move here.
But as
Those
Because
are the-
that is a lose argument.
Yeah, It's a,
But
it's a legitimate issue.
I'm
that Mr.
trying
Brock-
to, Senator Brock has the floor,
but
and
just-
I'm trying to let him either finish his first question or get on to his second question.
So just to finish that thought, Senator Brock, that was how we envisioned it, that it wouldn't be, okay, Vermont has a top income tax rate of 8.75% plus the 2.5%. Again, everybody puts their charts differently, but I think they also have explanatory footnotes as well. So hopefully that's the way we would be able to get around it. And that was our vision and our thought. So that, I hope that helps to answer, Senator Brock, what you were thinking, what you're asking.
Well, it does, except I would say that as you do your additional work before coming up with a final report, I would suggest that you have someone take a look at the major publications that publish this data and determine in the situation that we're going into right now, how you think they would treat it and whether we would wind up at least being reported, because people only read headlines, as the state with the highest marginal tax and income tax rate. And that's what I'm concerned about.
Mhm.
The second question I have is one of simplicity. That one of the things as we looked at property taxes, we were really trying to focus on is our task of getting up on a stage when people ask us, tell us how property taxes are computed. If there would be a simpler way that this would help us explain that, because right now it's inexplicable. Do you think this is easier to explain?
I think it's way easier to explain.
Property
I mean, that
taxes would not
How it was
be.
arrived, in other words.
Senator McDonald, you do not have the floor.
I was trying
In
to answer
terms
the
of how
question.
it was arrived at, when people want to know, where's my tax coming from? You know I voted down the school budget and my taxes increased by 10%. Why? Does this help explain any of that?
That's a different question.
Now, Senator McDonald, he's asking the question of the tax commission. You'll have your turn.
Okay, I think our main point was to make this simpler. And I think it is simple to explain what your property tax bill is. It's your spending per pupil in your district divided by the state yield, gives you % of your income that you're going to pay. That's it. No adjustments, no, property tax yields and that sort of stuff. So that part I think is much simpler. The part about you vote down the budget and your taxes go up, I think one of the things that is still true is that the locally voted property tax is really the shock absorber for a big system. And the system has all these taxes going into it that may go up or may go down in a year. So let's just say the sales tax goes way down and spending goes up 5%. And so people sort of expect that their bill will go up 3% or something like that. But it has to go up, not just to cover the increase in spending, but it has to cover the loss in the money that came in from the sales tax too. That is still true.
Okay,
Yeah, my last-
right. I'm just wondering what this does to Brigham. It will all go through the same equalization process? Okay. Okay, Randy, and then I've got
All right,
Senator
my last
Hardy.
question is, as I look back to the Blue Ribbon Tax Commission report, there was obviously a great deal of information in the report, a great deal of fact finding, but there was a majority report and there was a dissenting minority report. In this case, I gather that all three commissioners are united in their reporting. And I'm wondering, of course, whether that's good or bad. Was there any dissent in your arriving at your conclusions?
Well, maybe I should have started by saying that we felt we were coming from different directions in the first place, and we committed to consensus. So we had to work things out. We felt that we had to come to a point where we could all support the recommendation. It may not have been everybody's first choice, but we had to work through it.
And if I might,
we
I'm sorry, I was just going to say, if I might add to that, I think that ended up being a real strength because, one of us may have had something that looked like it was really sensible. And the other said, you know what, that's not going to work for the people I work with, my clients, my part of the economy. And we had to hammer it out until we got to recommendations that all three of us could support and felt made sense for Vermont as a whole and for Vermonters.
Okay, thank you.
Okay, that's it. I'll go to Senator Hardy, then Senator McDonald.
Thank you, Madam Chair. I'm really sorry that I had to leave during this part of the report. This is my favorite topic, I think, perhaps. So Deb, I think you took the lead on this. I would love to have another conversation with you, particularly after your final recommendations come out. But I didn't hear everything. So if you've addressed this in your comments before, I'm sorry. But Senator Brock, I actually have many, many times stood up on a stage and explained our education finance system to people at town meeting. You can talk to many people in Middlebury, and they've heard me do it over and over and over again. It's possible. It's also difficult to do. So I appreciate your attempts, the Commission's attempts to make it simpler. One of my concerns, though, and it sounds like there's a difference between the sort of quote unquote regular income tax and this new income tax that you're proposing in lieu of a property tax. So that may address my concern. But one of my concerns is the instability of an income tax versus a property tax. Property tax has lots of problems, but one of the things that's good about it is it's very stable throughout crises, which we've just seen and experienced. And so I am a little concerned about putting so much of our education funding onto a tax that's less stable and is more cyclical and to the whims of the economy and people's incomes. The other concern I have is one that I experienced personally as a fiscal analyst many years ago in Wisconsin, where they moved most of their education financing to their income tax as well, and had state, they cut the marquee word was 2/3 funding of education would be done by the state. And that lasted a very short time because they quickly backed off on that because education spending was blocking everything else out in terms of their ability to appropriate their income tax revenue. And so that would be another concern of mine, is that it would sop up the ability to levy an income tax, if you know what I mean, to continually, it would be like an ever continually increase in the income tax. So those are the two questions I have, and apologies if you've already addressed them.
We didn't actually, and the volatility question is one we spent a lot of time looking into, and we actually charted the volatility of the tax base, the income tax base versus the property tax base, and it's surprising, and did the statistics, and actually the property tax base was more volatile. Yeah, and but I think a really important point in terms of we talk about the income tax revenue being volatile, and it's mainly that we wait for, like this time of the year, we don't know what the revenue is going to be from the income tax, but we do from the property tax because we set the rate for the property tax. We don't for the income tax. In other words, we don't figure out our budget and then set income tax rates to bring that in that amount as we do with the property tax. And so our recommendation for the school portion is that we're going to set that rate to come in with the spending per pupil. So it takes away that revenue volatility worry that you budget in the beginning of the year and you don't get the money by the end of the year.
So it would still work the way it does now, essentially.
That's right.
You would
Yep.
still set the rate after the budgets have been passed locally.
That's right.
Okay. And what happens if there's an economic downturn and people just don't have the income capacity to to get to the level that we need to fund the budget.
Well, then they wouldn't have the income capacity to pay the property tax either. You know, so essentially you're paying school tax out of your income. So if we have that kind of an economic downturn, you're going to have problems in any tax.
Okay. And your thought about the income tax, because it's a different type of income tax than the sort of state income tax, it wouldn't block out the ability for us to fund general fund expenditures. It wouldn't essentially be the general fund.
Right. It would be separate.
Okay.
I would just add our thought and our hope and our notion is that it's pretty important to not think of this as an income tax, but an education tax based on income. There's the personal income tax, and completely separately, there's the education tax. And as Senator Pearson pointed out, the education tax now, 2/3 of Vermonters pay based on their income, and it's not seen as an income tax. So maintaining that perception of it being a separate education tax is important, I think, just for people conceptually to understand, but also, as Senator Brock pointed out, to the extent that we can communicate that to the ratings agencies and the people who do tax comparisons, if they show our education tax in a separate column from the personal income tax, we don't look way out of line in terms of our marginal rates. If they combine them, we do. And, it's sort of a communication issue that we need to grapple with going forward.
When you did your calculations, I'm channeling Senator Kitchell again and the warnings about the one-time money we've got now, because we annually have an $80 million gap between the revenues of the state, which are essentially income, and the cost of the state, which is pretty much driven by wages and pensions. That gap has caused us to critically underfund safety net programs. Mental health hasn't had a wage increase in years. I've seen the Green New Deal funded by a surcharge on upper income individuals. I have a thing that came across my desk this morning asking to sign on to a bill for 3% surcharge on incomes over 500,000 to pay for pensions. I believe there's another bill out there that is going to charge the same group of people to pay for universal primary care. It was in our committee, I believe 2 or 3 years ago, to do a surcharge on the same group of people to pay for free college. If we, and essentially, no, it's not an income tax. It's your state property tax based on your income. But there is one group of people that is, in all probability, going to see a significant increase in that payment, unless they really do have a huge mansion with lakefront property. Was there any calculation done for, what is it, the term, foregone opportunity, that if we take all of that, or do we know how much elasticity is at that end of the income? I think there's some, but I don't know how much. And if we take all of it for the property tax, does that mean we've cut off our ability to do other essential things like climate change, higher education, all those things we are not funding now and are looking to that top group to pay us off? Was that figured in here at all? Foregone opportunity, I think, is the.
No, I have to say we haven't. I'm not even sure how we would analyze it, but we haven't. And one of the reasons for looking at the tax structure is to try to look at all those different pieces and to put them all together. I understand that they haven't happened yet, but I think that's one of the reasons that you want to keep an eye on the structure to make sure that you're not getting all your taxes from a certain group, but that it makes sense overall.
I would also add to that, and I apologize, I don't have these numbers in my head, but I do recall seeing data around the way the tax burden was distributed across income cohorts after the Reagan tax cuts, which were seen as very favorable to higher income people. And if we went back to the Reagan tax cut regime, taxes would go up quite a bit meaningfully on the higher end of the income spectrum, which is to say the higher end has benefited more and more and more over the past 40 years. So, I think I am not in any way, I'm very sensitive to the concern that we are just looking to the highest income earners to fund everything in our communities. And I think there is room to go in that direction without getting anywhere near an unfair distribution of tax burden.
We've lost the chair. Mark, time
I get to
to
call on myself. On the last question for the members of the commission, but in the last examples just given where their tax has been proposed for the Green New Deal or teachers' pensions, etc., all of those proposals are to tax people of high income more in exchange for nothing. In this particular case, they're being taxed on their income in exchange for not being taxed on their property. So I would just say that is a fundamentally different. Is that a correct analysis?
Yep.
Okay. On Senator Brock's question which was a good one. If people in other states ask, say, well, how do people in Vermont, high people of income, what are their property taxes for education? And the answer would be, well, on their homes, it would be they don't have one, and that would be the answer. And it would be perhaps overly simplistic because one would say they have an income tax instead. Is that correct?
Yes.
Okay. The folks on the commission have said it's up to the people who write the 12 or 14 different booklets on how to compare states in their tax obligations, and that they should have more discipline and or do them with asterisks and fully report the subtleties from state to state to state. But many of those reports are not, they're written for political entities to use when those political groups argue in favor of things. So those reports will continue to be very disciplined and not include those subtleties, so that the people that walk around and to meetings and hold them up can pursue their political agendas. That's been what we've found routinely when we talk to when we look at those booklets, and we have no control over those. Is that correct? Or is that perhaps not the commission's area of expertise?
I think that may be getting more political, Senator, than they're comfortable.
I thank you, Madam Chair, for reining me in.
I apologize.
What
My computer has been shut
question
down in months.
For a question for Deb, who tends to catch what happens differently. If we look at the quintiles of spending in the state of Vermont today by school districts, each district being made up of property taxpayers, we find that the lowest, the districts with the lowest incomes tend to, in fact, spend the least amount per pupil. And the districts with the higher incomes spend the most per pupil. Is that likely? I was going to ask if it was likely to change, but would the amount of aid distributed under the formula cause that to change? The districts with the most income get the least amount of state aid. If it went based on income, what would those relationships, would they remain the same, or is that something we need to look at?
Let's see. Actually, I ran the 2018 numbers and tried to get at that relationship, and I found that that there are these conflicting relationships. That in our traditional small elementary schools that are only elementary schools, you do see that pattern. In our union schools, you don't. In our larger schools, you don't. And it seems to me, and this was done 2018 data, so not all of the mergers were complete. So it seems to me that the situation is changing based on the mergers. And the other thing that plays in here is the size of the school. That the small schools, particularly the small schools in low income areas, are the ones that are having the hardest time. And
They spend less, is that what you're saying? Or they spend
Yeah.
more?
they spend less per pupil. And part of the answer to this, or part of the reason I'm sort of hesitating here, is because we have weighted students and we have students. And the weighting, to a certain extent, offsets that problem. If we, you see more of a difference if you look at spending per pupil than if you look at spending per weighted pupil, because weighted pupil tries to account for, say, students in poverty. So I don't think that going more to income would make a difference given the current weighting system. But I think that the combination of the discussion of new weights, that our weighting is quite low on economically, so we have an economic weighting that's like, I don't know, fractions of what is recommended as the correct one at this point. So that would be one change. The other is just going to larger districts tends to merge those differences, I guess you would say.
And finally, Madam, thank you. Senator Hardy corrected me a week ago
I
on
think
the
We're
difference
gonna
between
need to move
weighted
this along
pupil
because
and
we've got two
actual
more taxes to get
pupil.
through by 3 o'clock.
And,
So
thank you. So thank you for clarifying that. And Senator Hardy was correct. It was also mentioned that there might be some stop on income similar to the one on Social Security. Is that just a maybe, or has that been looked at in where you pay the certain amount until you have a certain amount of money and then you don't have to do it anymore? Is that in the proposal, or does that remain yet to be reviewed?
That's a possibility. It always comes up. We acknowledge that, you know, it's something the legislature can do if they feel it's important. We didn't recommend it.
Thank you. Thank you, Madam Chair.
Senator Pearson, and then
Thank
on
you.
to the next two taxes and witnesses.
I want to come back to Senator Hardy's question because it is central to what you hear every time you talk about this, and that is the volatility of the income tax. Can you just remind us what percentage of the ed fund we're talking about impacting by this change?
We've had it broken out in a chart, but it's quite small because we're already, as you said, most people are already paying on income. So it's only a small shift. And we did look at the, one of the things that people compare in a tax structure is sort of the amount of tax that you're getting off of these three tax bases: consumption, property, and income. And we are currently way high in property. And if you move just this increment over, we end up being maybe high in income, but reasonable in property. So in terms of, is it a big change? No. And in terms of the volatility question, it isn't much of a change from now, but also we can control this on this income tax. We can control the revenue volatility in a way that we don't on the personal income tax, for example.
Thank you. I really look forward to more of these conversations. It's been really interesting.
A lot more of these conversations. I guess I've got Bram Klepner next, and I'd at least like to get all the taxes out on the table. And then we will definitely start wading through them. And ask Joint Fiscal to also do some analysis for us. Okay, Bram.
Thank you. So our recommendations for consumption taxes and the sales tax in particular generally follow the Blue Ribbon Tax Commission's recommendations. Following the principle of a broader base and a lower rate is a more fair, a more simple, and a more stable and sustainable tax. I had the advantage coming into this commission of being the only one who did not have a deep background in tax policy and tax law, which sort of allowed me to ask why to a lot of things. Looking at kind of all of the exemptions and exclusions from our sales tax, and from my point of view coming in fresh to say, well, why is that not included? Why is that not included? Some of the answers were no one knows that this was passed by a legislature many, many decades ago and has disappeared into history. But, it seems there are sort of a handful of pretty coherent reasons. One is to protect low-income Vermonters from a tax burden on necessities. Another one is to keep things that are good for our community, like education and healthcare, as accessible as possible. Another one is that some things just historically have never been included, so they're not, just sort of by inertia. That applies to most services. There's some things, there are a couple of exclusions that make sort of perfect sense: casual sales, yard sales and this sort of thing, and business inputs. So setting aside casual sales and business inputs, one of my jobs was to really push hard against every exemption and exclusion and see if the reasons to not include it in the sales tax were valid, and if the benefit from that particular exclusion outweighed the cost of the exclusion. And the cost of excluding anything, again, is complexity and the instability of a narrower base and fairness. And, noting that Steve and I sort of have 20 minutes to divide up, and that's 10 minutes each. I won't sort of take you through all of the kind of logic and reasoning and data that is in the chapter, because you can read that at your leisure. But our conclusion was there isn't a compelling reason to exclude anything from the sales tax, any consumer transaction of goods or services, except healthcare and casual sales and business inputs. And sort of the most fundamental logic is that excluding groceries, for instance, and I've got we worked out the actual numbers, which are in the report. But the state is foregoing, say, $100 million of potential tax revenue, and the portion of that represented by low-income Vermonters is maybe $30 million. So, we're foregoing $100 million to provide $30 million worth of protection to lower income Vermonters. And we used a pretty broad definition of low income, which is to say we took the lower 4 deciles of Vermont households. That roughly equates to 80% of median income, which is the definition Housing and Urban Development uses. It also sort of roughly equates to between 250 and 300% of federal poverty level. So, at that level, it just feels like the exemption of groceries from the sales tax, just to use groceries as an example, is not an efficient way to protect low-income Vermonters from that burden. And that creating a mechanism that gets the money that low-income Vermonters will spend on their grocery taxes every week back to them. And again, we heard from low-income Vermonters and their advocates that the mechanism it's important that it be a sort of weekly, every other weekly, and not a rebate at the end of the year that comes a year later, because we're dealing with a weekly cash flow and paying the bills every week and so forth. But with that mechanism in place, there's then greater capacity. So one can either raise more money or lower rates as one sees fit. It also makes the tax base more stable. And, groceries are a great example. In this current crisis, the meals and rooms tax got hit really hard. If we had the sales tax on groceries, the state's revenue would have taken much less of a hit because grocery sales went way up. So that's sort of the logic behind extending it to those categories which have been excluded to protect low-income Vermonters. There's a more efficient way. On the community goods, things like education, the question is the exemption from the sales tax an effective way to promote education in our communities? And, we spent some time on the barriers to higher education, and they are many. The price tag is absolutely one of them. A $40,000 a year price tag is, simply a huge burden / completely out of reach for a lot of people. And there are, in fact, lots of programs and aid to help people, but the data shows that the sort of price elasticity of demand for education and many of these things is pretty negligible on the order of a couple percent change. Excluding something from a 6% sales tax doesn't increase access, particularly including it doesn't decrease access. As we worked our way through it, it felt to us as though the benefits in terms of, again, stability of having a broader base and fairness in terms of taxing the products of Vermonters who create services the same way we tax the work of Vermonters who produce goods. There's, a fairness issue from both the consumer and from the worker point of view. And for simplicity sake, all mitigated towards expanding the base, as I said, to include essentially all consumer transactions except for healthcare. And, we looked at healthcare, and the draft that we posted during public comment, which you have, we investigated whether you could apply a sales tax to healthcare and get rid of the provider tax, and determined that would not work. And we investigated whether the provider tax could in some way be treated as a consumer tax. And, we sort of proposed and investigated that in the draft you saw. After discussion and public feedback, I think we've concluded that there's really no value in trying to sort of look at those two taxes together. So we've actually separated healthcare taxes into a separate chapter in the final draft that you'll see. And, finally, with a broader base, the question is, what do you do with this extra capacity? The Blue Ribbon Tax Commission was specifically charged with producing a revenue neutral recommendation. We were not. However, that seemed like a good baseline to start. So I think, sort of almost instinctively, we mitigated towards revenue neutral recommendations. And I would just digress for 30 seconds here to say that our hope is that overall, the structure that we have recommended, all the pieces together, is a more fair and more simple and more sustainable structure at whatever level of revenue it is called upon to produce. So our recommendation with the sales tax is, after ensuring that low-income Vermonters are kept whole for the categories that they are not currently paying sales tax on, which they will be. After that, and after accounting for the administrative costs of administering a broader base, that almost all the rest of the gain be put towards lowering the rate. And, we calculated that the rate could go down to 3.6%. But whether it's 3.6 or 3.8, it still leaves Vermont with the third lowest sales tax rate in the nation. So again, when we see those comparative charts, Vermont will look, really favorably on that particular metric. And, our sense is, like, when we look at those charts and when you talk to Vermonters, people are much more aware of the rate than they are of what's included and what's excluded. People sort of have a vague idea that some stuff's in and some stuff's out, but I think, again, as Senator Brock said, the headline that our rate is really low is what people are going to hear and understand, rather than we've included one of the broadest bases in the country as well to go with that one of the lowest rates.
Senator Brock.
Just a question. I know there have been a few changes since the time the Blue Ribbon Tax Commission report was completed, but one thing I recall was that their calculation of change in rate after the application of the sales tax to services was that the sales tax rate would drop to 2%, if my memory serves me, and now we've got it at 3.6%. The question is, what's happened?
So that is a good question, and I don't recall who I was talking to in the legislature, but one of your colleagues went through the exercise of, hey, the Blue Ribbon Tax Commission land, and they had this amazingly low rate. But as we dived into it, it was clear that wouldn't do it, and it ratcheted up. We sort of started from scratch, and there's, these guys laugh at me because I enjoy messing around with Excel, and but we built a tool to calculate, which we have circulated, and which you should have access to, which sort of allows you to say, okay, if we include this category, and this category of goods, and these two categories of services, what does the rate drop to produce equivalent revenue, and how much revenue do we get with those categories if we set the rate at whatever you want to set it at? I can't really compare it to the Blue Ribbon Tax Commission's calculation, but those are, sort of looking carefully at the numbers. That's where we landed.
So you didn't actually take a look at how the Blue Ribbon Tax Commission came to 2% and compare it to how you came to an amount that's about twice that?
That is correct.
Then let me ask another question. You came up with, I think it's like 2.5% on the income tax. That's what the income tax rate would be if you applied it across the board, if I understood it correctly. But then I look at the current rate of property tax, average effective property tax rate is now 1.86%. So again, I'm wondering where the difference is.
Well, you're comparing different bases, right? The 1.86 is on property value, and the 2.5 is on income.
Okay. Oh, of course. So when I take, though, the actual amount of the effective tax rate overall, I should be able to reconcile those two amounts, though, in terms of just the total amount drawn. And the total amount collected is the same in yours as opposed to what is happening now. There's nothing additional. Is that correct?
That is correct.
Okay.
Again, as I said, with setting aside the amount needed to keep low-income Vermonters whole from the tax on
Mhm.
necessities, and setting aside a little bit, not a relatively little bit. It's a lot of money to manage the administration of a broader tax and many more filers and all those things.
Okay. Thank you.
Of course.
Saw your hand up. Okay, any other questions? Senator Hardy.
Thank you. Bram, just a quick question on the applying the sales tax, to higher education. I'm assuming you heard from institutions of higher education and VSAC and others about that. Given so much attempts, the reason I left this committee is to go talk about a bill for scholarships for students at CCV and the Vermont State Colleges. It just seems like it would be counterproductive to apply a tax to higher education when we're trying very hard to make it more affordable. And so how did you come to that conclusion?
So, on a $40,000 tax bill, 3.6% is 1,440. For someone trying to afford that, $1,400 is helpful, but it doesn't really get you over the hurdle, right? You need a $10,000 grant. So, it felt as though, again, ensuring that education is accessible, taxing it is one way to do that, because there are a lot of people who can afford $40,000 plus $1,400. And so, it allows us to sort of collect from all the people who have capacity. And again, we recommend and repeat throughout the report that for this to work, to achieve the goals of fairness, it is important that the structures be put in place to make sure it doesn't add an extra burden to low-income Vermonters in particular. Again, broadly defined as the lower 4 deciles. And there are a couple places where we ran into contradiction. And Steve, I'm sorry that we're taking even more time away from you. But for
That's
instance,
see if our next witnesses can move back 15 minutes. So I'm going to get the committee a stretch break after this. So we'll find you some more time.
Thank you very much, Madam Chair. I appreciate that. For instance, we are very supportive of the transition to a clean energy economy. And at the same time, we are recommending an annual registration fee for electric vehicles to fund the transportation fund. And, we, again, worked to get to consensus on this one. I have driven an electric car for 2 years and am happy to recommend that I start paying an annual fee to the transportation fund, because right now I'm freeloading off you guys, right? Like, I drive around on the roads for free. You buy gasoline and you pay for the roads. So, our goal and design is to have a tax structure that will work over the next 20 years through all these changes. And we go from mostly gas-powered cars now to almost all electric cars 20 years from now. The transportation fund needs to be funded. So, recommending tax credits and other ways to reduce the capital cost so that more people can afford the initial investment in electric car and then benefit from the lower operating costs, we felt was not at all inconsistent with also, as these cars come onto the road, having all of us pay our fair share to keep the roads that we're using functioning.
Okay. So I guess any other questions for Bram? Senator McDonald.
There's we've got an amendment coming in, natural resources to collect a fee on electric cars for the next 2 years while a more sophisticated plan is developed. So
Great.
For your information.
Thank you.
Okay. Senator Bray.
Yeah. And we floated out, I think 2 or 3 years ago, a proposal to waive purchasing use on new EV purchases up to on the first 30K, and then to implement a flat $100 a year additional fee. And that was based on the average taxes paid that year by someone buying an average new internal combustion engine car, driving an average number of miles on Vermont roads. And so thanks for coming back to that one. We don't want the freeloader problem now, which is really small, to become a problem for the long haul. And there's no reason to have it be a thorn in the side of everyone who sees EVs and say those people aren't helping.
Okay. If there are no further discussions, I'm going to move us on to Steve and income tax.
Thank you, and I will try not to be as long because there's not as much meat to this as the other two. The Blue Ribbon Tax Commission did a great job in the area of income tax, and you implemented their suggestions. So we don't see, as far as personal income tax, we don't see any major suggestions or recommendations other than the fact that every year we talk about expanding the personal income tax base. That I'm glad to see that the governor has proposed to broaden the broadband internet. I think that's going to be, if that does in fact take place, that will be a good source of broadening the tax base, since Vermont is kind of a nice place to live. And if you can live and work remotely here, that would be great. And just continue to look at the personal income tax over the years, over the next 10 years, to make sure that whatever we have for tax expenditures relative to income are keeping up with the times. Are they doing what they're supposed to do, like the earned income credit, et cetera? So the next area we looked at was pass-through entities. And basically, relative to pass-through entities, we looked at, and I will preface this by saying this is not as a workaround for the SALT cap, okay? It produces a workaround for the SALT cap, but that was not the reasoning for this particular recommendation. We wanted to put forward the recommendation that the tax department take a look at the viability of two different things. One would be to have an elective pass-through entity that you could elect to be taxed at the entity level, which many states are doing. The other would be for should there be mandatory composite filing.
Okay,
Just
can
to
you tell us what, I've got SALT tax.
Yeah, I saw that. State and local income tax. That's the federal, that's the $10,000 cap on state and local income tax deductions.
LT, okay.
And that's been highly debated. And in fact, some of my colleagues at the Lake Champlain Regional Chamber of Commerce basically said, well, isn't that why you're doing it? And I said, no, it's just to make sure, again, we're looking out 10, 15 years in this, just to make sure that we keep up with the times. And there are a number of states in New England that are moving to that type of taxation of pass-through entities. There are pros, there are cons, but not having sufficient data to be able to look at it and say, if we did that, it would be revenue neutral, or it would be revenue negative, revenue positive. We floated it out there as a suggested research project. And as far as the mandatory composite filing, I know the state tax department has had issues in the past. I've experienced it firsthand with my out-of-state clients, that they forget to make their non-resident withholding payments on pass-through entities, and then it just becomes a nightmare to get the payments pushed to where they should be. So if you had mandatory composite filing, it would be taken care of at the entity level, but not taken away from the individual. The individual wouldn't have to file a return, but it would still be as if they paid the tax on the return. And we have composite filing now. It's mandatory for if you have over 50 members. If you have less than 50 members, it's voluntary. And basically on the corporate tax, again, we suggest or we recommend that you continue to look at Finnegan versus, doing the unitary calculation on Finnegan versus Joyce. And
What is
the-
Finnegan versus Joyce?
Okay, if you have a multi-state company that is not headquartered in Vermont, under the unitary apportionment factor, if it's done presently under Joyce, if you have one of your unitary members that sells into Vermont but has no other nexus in Vermont, their sales do not count as part of the apportionment factor. Whereas Finnegan, they would. We did not see that as a detriment to Vermont-based businesses, but rather as a potential source of competitive revenue, if you will, because there are a number of states out there that do it under Finnegan. And as a matter of fact, the Multi-State Tax Commission is looking seriously at suggesting for everybody to adopt Finnegan. That's it about for corporate tax. As far as the estate tax is concerned, and I have added something in the report that basically this recommendation is for the future. We just got the estate tax to a point where people understand it. You may not like it, but you understand it. You can plan for it, and it's not as convoluted as it used to be. I'll be the first one to say that was a long road, but Mark Langen and I stuck it out, and in 2016, we got that through. But there are going to be some changes at the federal level. There are going to be some changes to other states. The deemed sale concept is something that Canada uses as opposed to an estate tax. And basically what would happen is on the decedent's final tax return, subject to a floor of, a floor of a certain amount of money, the decedent would pay on their final income tax return basically like a capital gains tax, as if you sold all of your assets in your estate. It's something that has worked for many years for Canada. Who knows what's going to happen in the future? Again, we would be the first state to look at something like this. So I'm not sure that the legislature wants to pioneer something like that. But again, our charge was to look at sustainability 10, 15, 20 years from now. So it's a recommendation that's on the table. And basically, the only other area that I talked about was inefficient taxes. And Bram already mentioned the motor fuels and gasoline tax relative to, and it's not just electric vehicles, it's alternative fuel vehicles. As we get further and further into the alternative fuel vehicle, people buying them and using them in Vermont, that's going to further erode the gasoline tax base, which supports our road infrastructure. So that's something that, again, it needs to be looked at, balanced along with, we want for climate change, people to use alternative fuel vehicles, but we also have to be able to provide them roads to drive on, and that costs money. Last tax that we talked about was the telephone property excise tax. Everybody complains about it. Um, There are a couple of different recommendations that we made. One was to eliminate it altogether as it continues to go down and down every single year, and the cost of administration of it stays the same, and find alternative sources within the telecommunications area to make up for that revenue. The other recommendation was to add the possibility of cell phone towers to that, because now in Vermont, as I understand it, if the cell phone company owns the tower, it's classified as real property, subject to it's classified as personal property, which may or may not be being taxed depending on the locality.
That's our next topic of for witnesses, so that's very timely.
Okay, so I will keep my comments brief, so that you're already in tune to that. The other recommendation within the telephone property excise tax is to look at the basis of calculation. It's based on the net tax value, and with the dawn of bonus depreciation, Section 179, quick write-off, and what have you, it's pretty easy to erode that taxable base. If it were looked at as, okay, it's a 5-year asset, we're going to tax you based on a declining value over the next 5 years ratably. That may be more efficient and more fair. So those are basically the recommendations that we came up with.
Did anybody look at the cloud tax?
We did not, because that would have come under the consumption taxes, and it,
'Cause that's going to come up again this year, guaranteed.
well, and we were empathetic to that and tried not to come up with things in our report that we were pretty certain that would come up and that you've already talked about. And since that tax has already been in effect and probably will come back in effect, it was not something that we put in as our recommendation.
Okay. It's not going to come back into effect unless we vote for it. And so far, we haven't done that. Senator Bray. Yeah, Senator, you're muted.
Pressing my keyboard, but to no avail. All right. Plan B. On telephone poles and wires, I think of utility assets as being long lived, like 30 years, stuff like that. I don't really know quite how long a telephone pole lasts, but
You will in the next half hour.
Yeah. Are you differentiating between plain, sort of the telephone pole and things like that compared to the things hung on them? Because I don't know what the lifespans of all these things are, but 5 years seems relatively fast. And if it's relatively fast, what's the advantage of going to that rapid depreciation? I mean, are you trying to support the build out of broadband because there'll be a quicker depreciation? It's helpful to that company doing the building?
No. My point was, when you talk about telephone poles, for tax purposes, yes, they do have a longer life, but you're also talking about the switching mechanisms and what have you that generally for tax, when we say tax purposes, you may look at something and say, well, that thing's going to last 30 years. But for federal tax purposes, it may have a 5, 7, 15-year life. And anything under 20 years, you have the ability to write it off for federal tax purposes in the year that you place it in service, which would give you a 0 taxable value under the telephone property tax. And the reason you would do that is to save taxes in that one particular year.
Okay, thank you.
Mm-hmm.
Any further questions? If not,
I have a
committee, okay, Michael, you're cutting into break time now.
Okay, it may be better left for the next witnesses, but I think Tom Cavett had some serious concern about the drop in the telephone property tax revenues. And are those assessed values based upon only the time that they're put in? I mean, it seems like those poles are very valuable. If anything, they're going up in value. Everybody wants to get on them. Is there a way in taxation or accounting that you can assess the value? I mean, we do it in properties. Our home goes up in value, we pay greater taxes. Why aren't we looking at, as opposed to abandoning the tax, why aren't we looking at raising the assessed value of the poles?
Well, two different sides of the coin. One side is because it's so specific to telephone generation, and that's a dying enterprise. That's part of the reason that we said, and a lot of the underground utilities now too, in new developments. That was the impetus for a recommendation, for part of the recommendation that maybe that tax be scrapped. The next piece of it was, okay, if we're going to keep it, yes, I agree with you, Senator Sorokin. It does in fact need to be relooked at, and maybe it needs to be treated just like the local personal property taxes are. I own a restaurant in Burlington. I have to file my personal property tax return every single year, and it's based on whatever they deem the value of my equipment is, times whatever the local property tax rate is for personal property. So that is part of the recommendation to if we're going to keep it, let's make it meaningful as opposed to letting it slide and the revenue dropping every single year and making it almost an ineffective tax, if you will. So
This has come up before, Michael. It has to do with wireless that doesn't have poles and, ability to compete and requirements that are on regulated utilities, traditional telephone companies, as opposed to VoIP and wireless and all the rest. But we're going to get into that next. This came up from the Washington County Electric Co-op on the request for an exemption from their broadband build out. So we're going to take a break until 3:30. Then we're going to come back and start learning some history about the taxation of poles and infrastructure, utility taxation, and then we'll see what we're going to do. And if this is something that will encourage or discourage broadband. Okay, so Faith can put up the screen if you all shut off your video and audio. Thank you, commission members. There's obviously been a great deal of work gone into this. It's a lot for us to absorb in one afternoon. And George the cat has joined us, I see, and been thrown out for about the third time. And thank you. And we'll be back in touch. This is just our first walkthrough.
And Madam,
So thank you, everybody. I'll see you.
Madam
in 15
Chairwoman,
minutes.
thank you for having us as well.
Yeah.
Our pleasure.
Thank you all.
Thank you.
Thank you.
Okay, thank you.
Bye now.
Bye-bye.
Senator Bray, are you there?
Yes, sir.
Somehow you've become the host.
It's been
I've-
telling me I'm the host and then not the host.
Yeah.
It's done that like 12 times.
So just was texting with Faith. Her computer's down.
Okay.
So are you seeing people in the waiting room?
Yes.
Click
I
on
am.
participants. We need to
I-
decide if we should have the hearing. There you go.
Okay. There were 2 people in the waiting room. The usual flag didn't come up. I don't know why.
Madam Chair,
Okay.
just
Yeah,
I've been talking to Faith. She's having internet problems.
I'm
but-
having internet problems. Same one. Zoom. I left with it on, came back, it was off. It cut me off during the last set of witnesses. And Faith said she can't get on. So I'm on my, yeah, my iPad. But that means I got to find the agenda somewhere else. So we're going to start. Senator McDonald is here. But we're going to go through the history of utility taxation, right? And Joan, I know you're on. I'm still looking for my agenda. And as soon as I find it, does somebody else have the agenda up?
I'm opening it
Yes.
right now.
Who's first?
Madam Chair, there's an internet outage at the State House. Did you guys see that email? So
Yeah.
that may be affecting your internet.
That's probably it. I can't get on my computer, but I'm on my iPad. It just keeps doing that little connecting circle. And Faith is having the same problem. She keeps getting dumped. Okay, yeah, I just
So-
saw the
So
Zoom
the-
and email and mail seem to be down, so she's down. She's connected through the White House, the State House system.
So that may be why we don't have our state, the Will Baker and Jill Remnick were supposed
They
to.
probably don't get on either. Okay,
I think that
But we
also
have
might mean
Joan.
we can't stream.
oh,
Correct.
that's true too, and that means the protocol is we aren't going on.
Well, I think we are streaming.
Yeah,
Can
it says
you-
we're live
Oh,
on
yes.
YouTube. Everyone's watching
Okay,
us.
yeah, I see live on YouTube.
Right.
Up, change corners. Okay. So, Joan, you're here. Do you feel you can go forward with your testimony?
If the committee's ready, I can absolutely, kind of start with some information about utility taxation, and then hopefully the tax folks will be able to join. I know the state offices are having some issues with servers right now, so
Yeah.
they're unable to get on through if they're signing in through their VPN clients.
Yeah, and I had the same issue. So, okay, so let's start with you and we'll see how far we get.
Okay, great. So I've been in front of this committee several times before, but there are some new members, so maybe I'll just take a few minutes to introduce myself and also to talk a little about the Public Utility Commission and what we do. So my name is Joan White. I'm a senior analyst and also a hearing officer at the Public Utility Commission. And I've been in the energy sector in Vermont for about 10 years or so in different, capacities. Prior to this, I worked at the Public Service Department in their planning division, kind of doing long range analysis and energy planning for a sort of 20 to 30 year time horizon, in addition to working on rate cases and utility accounting issues. At the commission, it's a really small staff. We have about 10 hearing officers or so, and then the 3 commissioners. So we wear a lot of different hats. And one of the hats that I wear there is utility accounting and rate making, kind of being a point person on utility rate cases. So that's how I come to the topic of utility taxation. The PUC is a quasi-judicial agency, which is a little bit of a strange animal in state government. On the one hand, we act as an adjudicating body. So utilities come before us and ask for rate increases or changes to the rate structures, and we evaluate those. We also evaluate siting in the state. So siting of electric infrastructure, also siting of generation facilities, whether those are utility owned, merchant, or private facilities. We have jurisdiction over that. So those are our kind of cases where we serve as sort of an adjudicative body. There's another kind of group, which is we're almost like an agency. So when the legislature comes up with programs, for example, the standard offer program or the renewable energy standard or the net metering program, the Public Utility Commission is really charged with implementing those programs. So we conduct rulemakings where we kind of write out all the details of how it's all going to work. And we have a wide variety of stakeholders who come in front of us and make recommendations in that regard. And we also frequently draft legislative reports. So the most recent we submitted to Senator Bray's committee was the Act 52 report about, all fuels efficiency and how, in our view, all of that should work. So we're kind of can think of us as part court and part state agency. It's a little bit of an odd combination, but it's actually quite common in the world of utility regulation. With that, unless anyone has questions about the commission, I might just dive right into how utility property taxation works. And I know you've been having some witnesses in, so if I'm repeating what you've already heard, feel free to stop me and
No, we haven't.
Oh, you haven't? Okay, all right.
No.
Great. So maybe this is kind of new information. Yeah, Senator Pearson, did you have something to say?
Well, I was just going to say we had the utilities in asking us to not tax their build out.
Yes, I'm glad you mentioned that because so WEC is, as my understanding, is the kind of primary initiator of this request. And we are very likely going to see that as a legal issue in front of us. And so the commission absolutely cannot comment on WEC's proposal to build out fiber or WEC's proposal to that fiber. So because we need to kind of remain objective for when that issue comes in front of us for litigation, I can't comment on the actual proposal, but I can definitely give you some background. I don't know about the deep history. I don't have that necessarily, but I can kind of explain how the structure of taxation works and then how that taxation flows forward into electric rates, if that's helpful. So maybe I'll start. It seems like the main driver of this question is utility property taxes. So I'll start there. And so the authorizing authority kind of comes from two statutes. The first is 32 VSA section 3620, and that's for electric poles, lines, and fixtures owned by non-municipal utilities. So that includes the big private IOUs. IOU is investor-owned utility, so that'd be like GMP in this case. And it also includes the co-ops. So VEC and WEC are co-ops. There also in the state are a number of very small municipal utilities, for example, the department and Hardwick, like that. For those municipal utilities, for poles and wires and structures that are located within the municipality, if that utility is a department of the municipality, those assets are not taxed. And it makes sense because you wouldn't want to have one department of a town paying taxes to another department of a town. But it's also possible that it's not taxed for the state education fund purposes. Yes.
Okay, Joan, can I interrupt for a minute?
Please,
I'm texting back and forth with Faith. She is concerned that even though we seem to be live, that people can't get the legislative web pages down, and I just tried to get to that to get to my agenda, and it is in fact down, that people won't be able to find us. Well, so we're in kind of a gray area here. What would you all like to do?
The video is playing on YouTube where it'll be archived. So I agree that they may not be able to figure out how to get there, although some people are watching it, it says.
Okay. Well, we are live. Apparently anyone going through the State House system, Faith can't get on. I can't get on with my state computer. However, that's hooked up. But why don't we just finish with Joan and then we'll put the rest off for another day, see if we can move it into tomorrow. Hopefully the sites will be back up. Okay.
And I'm
So,
happy to come back tomorrow if that suits the committee. I mean, really, whatever you think is right.
and you're here. Let's finish this up. And
Can I,
Senator Pearson.
so Joan, I'm sorry, you went through quickly. So
Sure.
municipal utilities don't pay property tax.
Right.
Do the co-ops,
Yes.
Greenmount Power pays property tax, Comcast pays property tax. Do the co-ops pay property tax?
Yes, they do. Yes, they do. So these are numbers from their most recent rate case, which was last summer. So this is subject to check. I think Patty Richards could probably comment on this, but WEC pays around $380,000 or so annually in property taxes. For a sense of scale, Green Mountain Power pays kind of roughly $31.6 million a year in property taxes. So it's a fairly substantial amount of money.
Now, is it the poles? Is it the wires? Is it, because we just had the tax commission suggest that we do away with the telephone property taxes. It's the poles and the wires?
Yes. Yeah. So I can actually read you the whole list as
Okay.
it's laid out in statute, but then I can kind of describe from a systems point of view, like if you're driving down the road, what you might see and how that might be taxed. So the other statute to look at is 32 VSA section 3602A, and that was passed in 1999. So that's relatively recently. So all structures, machinery, poles, wires, fixtures of all kinds and descriptions used in the generation, transmission, or distribution of electric power, and blah, 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 some other stuff. So all of that goes into the grand list of the town, and it's appraised using the appraisal value definition in section 32 VSA section 3481. So it's taxed as kind of property. And usually how this actually, well, maybe I'll describe the infrastructure first. So it's basically what we're talking about is poles, wires, substations, generating facilities. Those are the main assets that utilities are going to own. So you're driving down the road, you look up, you see poles, all that's taxed. You pass a substation, which kind of has these big bucket looking things, that's all taxed. All of the generating stations are taxed. So the hydro facilities that you might see, we have a number of peaker units in the state that are also taxed. Solar has its own tax structure. I'm like assuming you're familiar with that, but that's not, most of the assets are not utility owned. The utility owned solar assets are taxed in the same way that their property would be. So a distinction to make is that for poles and wires and substations and all that kind of just the skeleton that holds the electrical system, that's all taxed based on a depreciated value of the asset. So for example, WEC right now has around, like, let's call it $85 million or so in real assets. And so what you would do is you would take that plant, we call it plant in service, utility plant that's serving customers, and you kind of depreciate it over time. So the utility just reports to the town assessor every year, hey, here's how much the stuff in your town is worth. And then the assessor just applies kind of their town tax rate to it. For generation, it's slightly different. It's based on how much electricity was generated by that generator and how it was valued in the market in the previous year. And this is not necessarily a cut and dried calculation. There are instances where municipalities get into litigation with the utilities over how much their assets are worth. So we've seen that most
The dams fit in there, right?
Yes, yeah. So for
Hydros,
example,
yes, there's been some
hydro.
big lawsuits.
Yes, that's been a hot topic. Lucky for us, we don't litigate that. That all happens in Superior Court. Like, we don't touch it. Or I mean, it goes up to the state tax assessor and blah, blah, blah. So that's not our thing, but that's not a cut and dried issue, how much generation is worth. It's also not super cut and dried on the depreciation side. So there's a fair amount of litigation about Do you use straight line depreciation or do you use this accelerated depreciation? And there are different schools of thought and different cases have gone different ways. But for the most part, like I'm going to say 95% of the time, what happens is the utility keeps their own books, they track their depreciation, they report the value of the assets to the town, and then the town sends them a tax bill based on their rate.
Okay. We've created CUDs and defined them as municipalities, like school districts. And are they tax exempt for any wires they put up?
My understanding is that they are, and that applies to both the state education fund property tax and the local municipal tax.
So that is where I guess we've been encouraging the electric utilities, the co-ops who are stringing fiber so they can do their smart meter, and to make that fiber available for broadband. But if they do that, then they're going to be taxed, which they then can't do it cheaper because of their borrowing ability than the CUDs, because the CUDs wouldn't be taxed and their electric users would be taxed. We picked up Will Baker. Is the State House back online?
I don't know about that. I'm at my house, so.
Okay. The State House is down, but our indications say that we are live streaming, so we're moving forward. And Joan is the only other person that's managed to get here, so
when Faith got bumped off, somehow I got made a host, and so I just saw these names in the waiting room. So, and I recognized them, and I let them in.
Okay. Oh, you're the host. Okay. Because I got bumped off too, and I got bumped off earlier today, and that hasn't happened since I got the state computer, and it just, everything froze. So
over Senator McDonald's objections, I did let you back in.
Thank you. If that might be also to your good, because if you didn't let me back in, he's chairing. Okay, so Joan, go ahead. Will Baker's here somewhere. All right.
All right. Let's see, where was I? I mean, I think I basically just want to answer your questions. That's kind of the baseline of information, but you know, I could go on at length about all the other taxes that they pay and how income tax works and yada yada. But I think the main thing you're after, it seems like, is really the property taxes and CUDs.
Yeah, we've got this request and it's legitimate. I mean, their electric users shouldn't be paying tax when they may or may not be broadband users. We've encouraged them to look into this. It sounds like a lower cost way to help the CUDs. If they could just sign on to their broadband, they wouldn't have to go out and borrow money at 3 something as opposed to paying a lease. But do you know the history, or I'm not sure who's going to do it. Did we tax electric poles and wires when we first thought getting electricity out was a necessity, or did that come later?
Oh, okay. Well, I don't want to interrupt if Senator Bray wants to add to that.
Thanks. I'll wait.
Okay.
For
okay.
Okay.
Yeah, so that's a splendid question. So I don't have the deep history on this, but I know that the statute that specifically describes utility infrastructure as property which is taxable didn't come online till like the mid 80s. So does that mean that, you know, I truly don't know what was happening in at the town level before that. It's entirely possible that they were imposing taxes, but in terms of like specifically authorized, it was in the 80s. So during that period, the 40s through the 60s, when we were kind of really trying to get like the first service out to those way yonder farms, I don't know whether that was taxed.
it is counterintuitive that we would tax it. And we're kind of in that same beginning stage with broadband and just trying to figure out how we might do this. But at some point, that broadband is going to be a valuable asset once we get it out there. So I think we're looking at this. Senator Bray, I've gotten, and Senator Pearson, did you?
Yeah.
Okay.
So
Senator
the
Bray.
question I have from Ms. White is, so what kind of thinking and analysis do you go through when an electrical provider now start to provide an on-core service, like communication services, they're building out broadband infrastructure. I know that they themselves are intending to use it at some point when management of the grid, in order to modernize their management of the grid and offer new energy saving services to their customers. So, but at this moment, it seems as though what they're doing is building out infrastructure for a non-core service. And actually it could be a profit center to them, which has some benefits to their ratepayers, right? But I don't know how you sort that one out in terms of applicability of tax, and is there a broadband infrastructure tax charge that others bear currently?
Yeah, so I'll speak to I'm sorry, Senator McDonald, did you?
I think we're discussing that Senator Bray's asking a question about whether something that has not yet come up might or might not be a good idea. So is there anything in statute that would prohibit the legislature from saying notwithstanding, et cetera, et cetera, et cetera, broadband or
Senator McDonald, sorry, could we let the witness answer my question first?
Yeah.
All right.
That would be great.
Yeah. So all right. So let me just think about it. Let me talk about it from a rate making point of view, which I think is what Senator Bray is getting at, which is, so yeah, we absolutely have instances in which utilities develop non-core services. And I'll just say it's a very gray area. So often if a utility is doing something that we feel could be provided in the private market, they spin off a subsidiary, and that subsidiary kind of exists in its own accounting bubble that is not put into rates. So ratepayers are not on the hook. For fiber specifically, there's this unification kind of happening with the need for telecommunications and effective electric service. So the biggest case in point is Velco. They've got a very robust fiber network, and it's built into their transmission rates, which FERC approves. And the purpose of it is for reliability. It's also for critical two-way communications. Like, we're now emerging into this utility environment where it used to just be you could only control the generators. So people turned on their lights, you couldn't do anything about that, and you just kept turning on generators to match up with it, and you had to build the poles in between big enough to make it all work. Now, what's very confusing and that the utilities are rapidly adapting to is that now we could potentially control customers' load, we could dial how much electricity is needed up and down, and the amount of generation fluctuates up and down because it's renewable, and you can't really control when the sun is shining or the wind is blowing. So what you've got now is kind of two parts of the system that have a lot of variability, and what you need is technology that allows the utility to synchronize the flexible loads to the intermittent generation. So I would say that the utilities building out communication infrastructure that supports reliability, that creates the grid to balance load and demand in an era of intermittent generation. There's no doubt that there's an electric component to that. But as far as how it rolls through the rate making, which I think is kind of at the heart of your question, if we got a rate case and someone said to me, you know, we invested $10 million in fiber, you know, we've got X percent of that money we're recouping through revenues that we're getting back on a lease. And we're also using the fiber for this utility application. I think that would just be like a really gray area, and we have not really gotten into that issue in a rate case yet. So what I guess the question we would ask is like, what percentage of the cost of that fiber is really caused by or due to the electrical applications? And what percent is caused by and due to the sort of broadband build out for your customers? And the key issue we're trying to avoid is cross subsidy between those types of. So you don't want the electric customers to pick up the tab for the broadband build out that's like mainly to get internet into people's homes.
Okay. And the last, just a follow up to make sure I understand the rate piece is the broadband infrastructure treated like another capital expense on which there is a whatever traditional rate, the rate case delivers a rate of return on capital. So that's how it gets treated. Okay, thank you.
Yes, and it's worth noting for the munis and the co-ops, they don't have, they have sort of this thing that's almost an equivalent of an ROE. So the members of that muni or co-op basically put up cash, and that helps support the debt market. So then the co-op can go to their bank basically and get loans. So, but it's not exactly the same situation with a Green Mountain Power or a Vermont Gas, where you're building in an ROE on top of that. So I would say, yeah, just that distinction is important.
Thank you.
Okay, Faith has joined us. The State House is rerouting most systems. Senator Pearson is now host. I've just got a notice. So Senator Bray, you lose.
Phew.
And we're going to continue. I think Will Baker and Abby Shepherd are here with us. I still can't get my agenda up, but we'll keep moving. Senator McDonald.
So might the witnesses consider responding to the following question? If the legislature were to pass a bill or put forth a bill that says that broadband hookups on co-op owned poles to be leased to private enterprises with certain conditions such as open access or just open access, or even upon a condition of specified rate controls. If they had such lines on there and the legislature were to say shall not be taxable, is there anything in FERC or anywhere else that would nullify such a bill? And then we might discuss whether or not doing this is a good idea.
So it's if the issue is property taxes, FERC doesn't really get involved in that. So I don't want to say definitively because I don't have like all the FERC case law related to taxes top of mind, but it's really truly jurisdictional to the states and the municipalities how they're going to treat property tax issues.
So that's sort of a yes, even though is that a yes or?
It's a yes subject to check. Let's say that.
Thank you. Thank you.
Okay, other questions at this point? I'm still looking for my agenda. There it is. Okay. So committee, any other questions? Joan, anything else you think we should know about? At this point, we are just starting on this. Senator Bray has a question. Everybody is joining us now.
The quick question is, if a company that's stringing broadband infrastructure, its primary business is communications or telecommunications, then is that property taxable?
My understanding is yes, unless it's a CUD, which is specifically exempted. My understanding is telecom infrastructure is taxable.
Right. Okay.
The issue came up today with the tax commission about cell towers and how they're taxed. Do you know anything about that? Or not taxed?
Yeah, I don't. We don't regulate their rates. So the
Yeah.
visibility I get is mainly through rate cases, on the utilities and their
I
tax.
think it was, if it was owned, it depended on who it was owned by, if it was personal property or not, so. Okay, other questions? The internet somewhere in the State House must be up because people are joining us rapidly. If there's no more, thank you, Joan, for sticking with us and being our one person who could get here. But I think we have everyone. Will Baker, are you there, Will?
I'm here.
Yes. Okay. And you and Jill Remick is also here. You were going to talk to us a little bit about the history. The question I asked, I don't know if you were here or not, was, did we always tax electric poles and wires? Or, when we thought, as we do with broadband, there was a necessity to get everybody hooked up as quickly as possible. And when did we start and how did we do it and whatever. We're just starting on this very technical road.
Okay. I'll go first. Jill Remick is also here, and Jill,
Yeah.
please chime in if you'd like. My name is Will Baker. I'm legal counsel at the Vermont Tax Department. Let me just start by saying that the underlying premise here is that real property subject to property tax, land and buildings subject to property tax, personal property, business personal property is subject to municipal tax unless the municipality has decided not to tax it. And I believe that only about 44 municipalities tax business personal property at this point. So that's sort of that's the underlying foundation here. And then I should also mention that of our 30 tax types, property tax is actually not one of my specialties. So we may have to research questions further and get back to the committee. And I'd also point out that property tax it's spread over 251 towns. So we probably can't get you specific answers about is every single category subject to tax, because we would have to go and look. The tax department itself doesn't list the properties, the municipalities do. And then finally, even looking at the grand list, we often don't get the level of specificity that this committee may want. In other words, if I run a shoe store or a consulting firm, that's still real property, commercial property, and it would be listed in the grand list as commercial property, whether it's a shoe store or a consulting firm. So we can't hone in on the grand list as far as internet providers or anyone else, other business, probably to the level that you would be most helpful to you. So that all that said,
interested in the taxation of poles and wires.
Mm-hmm. Okay.
What's taxable? Who taxes them?
So generally, there's a couple different categories, but there's no. Jill, correct me if I'm wrong, but I don't think the word internet appears anywhere in the property tax statutes. So it's not like we do not have a internet provider category of property, and there's no specific rules for internet providers. But there are some other categories that come into play here. But following the underlying premise that all land and buildings are subject to property tax, and personal properties, depending on the town you're in, subject to municipal tax. Cable TV provider who might also provide broadband internet through their cable network. The the land and buildings for a cable TV provider or internet or cable TV provider would be subject to property tax. And cables, lines, fixtures, and poles would be taxed, would be subject to education tax. They're included in the definition of non-homestead property and education tax.
Okay, so if Comcast strings fiber or cable or whatever on poles owned by Green Mountain Power, who pays the property tax on that cable?
I think it probably depends on who owns them. If it's Comcast cable and they string it in a particular municipality, it would be subject to education tax. Cables, lines, fixtures, and poles are subject to the education tax.
Okay.
If they don't own the pole, but they own the cable, then I imagine that is the value that they would list, that they would, on which they would be taxed in the town. There are some specific rules that are slightly different for telephone companies in Vermont. And it is possible that some telephone companies, as defined, also provide internet.
Yep. Okay.
And then, Senator Cummings, you asked about the history. My observation of this chapter of Title 32 is that it does not change very often, and it's been in place for quite some time. Unfortunately, before 1947, I don't have a good way to research here at home. The statutes, our current style of our statutes really got started in about 1947. So that would be more like legal historical research. We might have some paper materials in our office, but I'm not in our office. But I think that this has been the general structure for quite some time, maybe forever. I did review some materials. It's not quite on point. It's not property tax, but we did have a franchise tax in Vermont on telephone and telegraph companies since 1882. That it went in 1882. So we have certainly been identifying telephone companies for tax for quite some time. I don't see anything that exempted them for the purpose of encouraging building out of that service. There certainly could have been one. Certainly could have been incentives to do that. I know that there were incentives to do that. I don't see anything on the property tax side, in the property tax area, suggesting anything like that.
Okay. Any questions for Mr. Baker? Thank you, Michael. I was getting tired of looking at the top of your head. So you can talk.
Thank you, Mr. Baker. I asked this question of a previous witness. I don't know if you can answer it, but we were informed that the revenues from property taxes on telephone poles, I don't know if it's limited to telephone poles, has dropped substantially in the last few years. And there was a concern about that. And I just don't understand how poles and wires, whether it's telephone or cable, whatever, get valued or assessed. And, we hear a lot of talk about the desire to use those poles by some companies for various purposes. And I don't know if their value goes up and who does reassessment or reappraisal like we do with homes. Can you educate us a little bit on this?
To Jill.
I can start, and maybe Jill can fill in some details. Telephone companies do enjoy a little bit specialized tax treatment, and that's because of our telephone personal property tax in Vermont, which is a very old tax. also has not changed very much over the years. So for a telephone company, and a telephone company is defined as someone operating a telephone business, pretty broad definition. Of course, land and buildings subject to property tax as usual, as you might expect. But the poles and lines, there's a special telephone personal property tax on that equipment. And that's a tax on the net book value of the personal property tax. And then they're exempt from any municipal personal property tax. And the state personal property tax is on the net book value of those assets, which I believe the prior witness is correct in the general statement that that is a number that is shrinking over time as those assets are older and older. And my understanding is that there's not a whole lot of conventional telephone upgrades occurring right now. I don't have the technical background for that, so I don't know exactly what I'm talking about when I say that, but I mean the older what I think was an old-fashioned telephone line upgrades. So a tax on the net book value, the tax base on that would and is shrinking over time.
So there seems to be, I'm sure you could probably come up with, or we could come up with some examples where that might produce some inequities. But in terms of, I was struck by you saying there's no right for a municipality to tax the telephone poles. Is there an example of similar utility property that enjoys that exemption?
I believe that's correct, that if the asset is subject to the telephone personal property tax, it is not subject to any municipal personal property tax. And is there any comparable situation like that? The only thing I can think of is utility property that's actually owned by the municipality and occurring in that municipality that would also be exempt from municipal tax. But that's the only example. That's the only similar example I can think of.
Well, a starting point for me or for this committee might be to do some comparison to how other states treat this property. Do you know off the top of your head whether other states have updated their statutes to reflect the loss in revenue or the inequities of certain personal property of a utility being exempt while we all pay our own tax, other businesses pay taxes on their personal property?
I don't know specifically.
Okay.
I know we've made changes. I think one of the issues is that who's the last person you know that put in a landline? Everybody's getting rid of their landlines and going to cell phones. I know we've had the smaller telephone systems in a number of years ago because they were regulated. They had to go through full PUC hearings to do bundled programs. They have to provide the lifeline connectivity, and cell phones don't. And VoIP, voice over internet. So if Comcast or any of those providers, we can't tax that, right? We can't tax internet. So anything going over there, I don't know about cell phones. Do we tax? And we came up with cell towers were vague as to how they got defined. So The industry is changing. The feds have tied our hands in some areas. And yet we've still got some regulated utilities out there in telephone. The service has been restored if everybody's not getting the same pop-ups I'm getting. So we're back online live. Senator Pearson and then Senator McDonald.
Thank you. I'm the proposal that has come to us is to let the co-ops build some infrastructure that will be used by the CUDs. Now, if the CUDs could build it, we've all agreed they would not be subject to the property tax. And it's an interesting question because it's a question of ownership technically, but really the user, the person that's using it, it's already clear there wouldn't be tax. So I guess if the CUDs could contract with the co-op to do the work of building it, that would also not be subject to the property tax. The trick is the co-op has access to a very favorable financial instrument to be able to fund the whole thing. My question is, from your point of view, is there a concern? Is there an integrity issue if we give them this exemption for this purpose? To me, it does seem to jive with our desire to build out broadband and our desire to make it be fiber and to empower the CUDs. So I'm just curious if you would have concerns with this proposal, if it has integrity to you.
I don't know a whole lot about this proposal, and frankly I don't know what a CUD is.
It's a community union district, communications union district.
Union district.
It's EC Fiber.
EC Fiber, Central Vermont Fiber. And we have defined them as municipalities.
Okay. And I perhaps Jill Remick should chime in on this as well. From the tax department's point of view, what we always really like to see is clear definitions of an exemption from tax or clear definitions of what is subject to tax. So me personally, I don't have any concerns if certain property was going to be exempt for certain use, as long as that would be workable for the company or the district, the utility, to identify what is within this exemption and what isn't, and then likewise for municipal assessors in the state to do the same.
Okay.
I know one other comment I'll make about that is I could see a problem occurring if they conducted both taxable and exempt business over the same piece of equipment. My thinking there is a cable television cable and a cable broadband modem, or something like that, where you're using the underlying asset for perhaps more than one thing. And if the tax treatment is different for those two things, I could see that being a complication for the company to sort of try to prorate or calculate in some way how much of it is being used for the taxable purpose or the exempt purpose. That could be problematic. But if the whole asset is being used for one purpose, and we had a clear definition of that purpose and taxable or exempt, that would certainly satisfy me and probably the tax department.
Okay. Jill, any thoughts?
Hi, everyone. Jill Remick. I'm the Director of Property Valuation and Review at the Tax Department. I wanted to just go back and provide a little bit more foundation to one of the original questions about how utilities are currently assessed. If you do try to find information about utility utilities in the statute, different utilities exist in different places. And so it's not sort of all really laid out very clearly. And you can tell over time things have been added and amended. So in some cases regarding like cable TV and electric, it's pretty outdated and unchanged from a long time ago. But then we do have sections in there specifically for things like solar and cell tower. So it's a partnership between the state and the municipalities. I think that's part of why this is so challenging and hard for us to give you folks definitive answers, because we aren't able to report to you, okay, this is what broadband providers are currently being assessed at, and this is what they're paying in property tax, because the statute, the way it is right now, doesn't contemplate the term broadband, right? You can get it from your cable, like I have mine through my TV cable that comes in my house. My mom in the Northeast Kingdom has a satellite dish, and that's how she gets her internet. So it's hard to quantify. I don't want you folks to think we're trying to be evasive, but right now, as with a lot of the property valuation, then when there's something physical, there's real property or personal property that's measurable that we can assess, we can do that. I think what we're running up against here is that I do think, utility valuation in Vermont is a little ripe for some revisiting and freshening just in general, to keep up with what's happening in 2021, where it really hasn't changed substantially for the past several years. And so I wanted to make sure that I just made that clear, that depending on the type of utility and the sort of bucket that it falls in, it's treated a little differently in statute. And and every year we collect a inventory from all the utilities. So to get at like the poles and the lines and things like that, we collect that every year from all of the municipality or all the utilities. And then we have a formula related to what's called the Handy Whitman. It's a national formula. It's sort of a standard of what the inventory nationally is doing, and that gives us a value. So then the municipality can either use that value, or they can come up with their own utility value. So if you have a particularly high value commercial utility in your town, you may want to actually take the time to invest in having a professional utility appraiser actually provide that valuation. The state does have a partnership with the towns related specifically to the TransCanada Hydro. So there is an expert utility appraiser who provides their expertise and their valuation on those. It's not something that we have the expertise in-house at the tax department to actually do that. It's a pretty specialized field. So I'm happy to have this sort of come before you folks so we can sort of start to unpack some of these pieces. But right now, we've kind of built this system. The technology is moving faster than the statute and the tools that we have to come up with proper values. In other states, we spend a lot of time with our counterparts in New Hampshire. As you can imagine, property tax is a worthwhile investment for their valuation team at their tax department. They have a whole staff of folks who do utility valuation, and it's really much more based on sort of an income approach on a business model. It's almost like their team does more of an audit of their FCC filings and things like that, and that's how they come up with the value. And then they can apportion that based on number of ratepayers in towns, or, we're also kind of unique in that we divide it by municipalities. In a lot of places, it's maybe more like the county or statewide. So we have been doing a lot of looking into what Vermont could do better, what tools would help us more accurately capture what we need, and also to get us some more training on how we can support the towns to come up with these values. So utilities is definitely something we've been trying to dig into a little bit deeper. But yeah, to Will's point too, depending on the type of utility it is treated differently in statute, and it might be personal property that is taxed at the municipal level. It may not be. So it's worth a discussion.
Okay, Senator McDonald.
Madam Chair, it's interesting to know that utility may be ripe for changes. And we're discussing value here. Broadband, at least symmetrical broadband, has been valued by many in the recent years as the single most valuable thing we can do for economic development. So my question is, for the witnesses who've just testified, is there any reason why they think a law which said, notwithstanding current practices, this broadband to be defined as symmetrical up to such and such, or a federal definition of broadband, is there any reason why such a law would be overthrown for being preempted or et cetera, et cetera? And that's pretty much it. If they have a reason to share it, if they don't have a reason, they can say no. And the second question would be, if we were to draft such a bill, would they come and comment on it and whether or not they thought it was a wise and thoughtful way to achieve the number one valued economic development tool of broadband throughout the state of Vermont? Those are my two questions.
And who is your question aimed at?
Well, we've had one witness said that they didn't see any reason why we couldn't pass such a law. Ms. Remick, do you see any reason why we couldn't pass such a law? Would we be preempted?
Sure. I think the way that it could be effective and implemented is to be really clear to your point about what the definition of broadband is. And in so many of these cases, the utility is offering multiple services. So how to parse out if you are a Comcast or something that uses it for telephone and cable and broadband, how you parse that out if you're treating them differently for taxation purposes. So as long as those things can be clearly defined so that we at PVR and then the municipality can quantify that value, then I'm sure that the providers would love to come in. I haven't interacted much with broadband providers, but we've certainly had conversations with like electric, telephone, and other utility providers. So I would assume they would also want to come in and speak about how that might impact their liability or their decision about whether they do offer broadband using their existing infrastructure or build out. So I'm sure there's others in the industry who would love to participate in that conversation and have much more to say than I would about that.
Yeah.
Well, Madam Chair, if we were to say that it is not to be taxed, then the value of what the thing is that isn't going to be taxed would be interesting to discuss. But 0 times something is 0. So for broadband on cooperatively owned poles to be leased under certain conditions to provide broadband service to those areas. Now, maybe some will tell us whether that would be a good idea or not. And in the interest of achieving the number one goal professed by many for our economic development.
I think we're the ones that are going to decide if it's a good idea or not.
Okay, well then we don't need the witnesses to comment on that. Are we ready to present them with a bill that they can comment on whether it does and is clear enough to do the job?
Right, and whether or not it's legal.
That's my question.
Okay.
I've had one other example, if you don't mind. I know it's getting late. One of your questions was just about how different entities are treated differently. I don't think there's any pocket that's sort of getting away with anything, but certainly the sort of inventory and tracking of the resources is our biggest challenge at PBR and the town's biggest challenge. If we don't know about it, we don't know that we're missing that, missing to identify that entity. One that comes to mind that I think is timely is the railroad corporate tax. So we still at PVR value railroads based on their track mileage and collect revenue on that and disperse that among the towns based on the miles of track. And because of that, those railroad entities, that's their payment of their corporate tax. So they're exempt from a corporate tax. So there are ways to, I think it might have been Senator Pearson who was asking about, making sure that we're capturing the right assessment through the right venue. So there are other examples where that goes in the reverse, right? That if they're not paying real property tax, it doesn't mean they're not in another way, maybe, paying some form of assessment on their property. Maybe I just made it more complicated. I apologize.
No, and I know
co-ops pay corporate taxes.
Not corporate.
Okay, so if the answer is no, then that's not an issue from the co-op point of view of paying taxes on this. Or if it is an issue, someone please say so.
Okay. All right. I don't know if it is, if anyone knows that or not. And things change. The railroads are not the economic drivers and necessities they were 50 years ago, 60 years ago. Things have changed for landline telephones, and our challenge is to make sure that our taxing structure is fair and, you know, doesn't disadvantage anyone, and also helps encourage behavior perhaps we'd like to see. So with that, not seeing any other questions, I'm going to say thank you to everyone. And we will see the rest of the committee here tomorrow afternoon. And I think Faith has posted the agenda. It will be up. It's pretty full for next week too. Get any issues you'd like to have put on the agenda to me, and we'll find a space to get them in. And we'll just keep getting on.